How exactly should you pay yourself as a business owner? Is it as simple as transferring money from your business account over to your personal account? Or is it as complex as putting yourself on payroll and paying yourself W-2 wages? Well, in this video, you are going to learn the correct way to approach this once and for all. If you're new here, my name is Sherman the CPA and I specialize in tax planning for businesses with over $100,000 in income over at mycpacoach.com. My clients come to me because they don't want to pay Uncle Sam tens of thousands of dollars in extra taxes than they actually have to pay. And I help them accomplish this through a variety of different ways, but one key way is by helping them find the best way to pay themselves from their business. There are tax consequences associated with the method you choose to pay yourself from your business. There's income taxes, self-employment taxes, payroll taxes, capital gains taxes, and more to consider when you are choosing the best method. And when it comes to those payment methods, you can take owner's distributions, owner draws, W-2 wages, and dividends from your business. And the method you select should be appropriate based on your business type. So an LLC may pay themselves differently from an S-Corporation, which is different from a C-Corp, and so on. So let's walk through all of this in the simplest manner to help you figure this out once and for all. All right, so let's start with the simplest way to pay yourself from your business. Owner's distributions, also known as an owner's draw. An owner's draw is simply the act of withdrawing money from your business, and you make an owner's draw every time you take money out of your business account and transfer it over to your personal account. You can withdraw cash, write a check, submit a wire transfer, and so on from the business to its owners to make an owner's draw. But how exactly are owner's draws taxed? This is very important to understand, and it depends on your entity. And some entities have more red tape than others, but also pay less taxes, which we'll talk about a little bit later in this video. All right, so let's start with pass-through entities like sole proprietors, partnerships, and LLCs that are not taxed as corporations. If you are not a corporation, then chances are that you are a pass-through entity. And all this means is that in the eyes of the IRS, your share of business income passes through to you personally, which just means that all the money your business earns is considered your personal income if you own all of that business. And the tax you pay on that income will depend on your individual tax bracket, which also takes into account all other forms of income you receive and report on that return. Now, here's the thing. As a pass-through entity, the IRS considers you and your business one. The business income effectively adds to your personal income on your tax return, which is big because this means that you will be taxed on your business income regardless of if you took any owner's distributions or not. A lot of my clients get this confused. They think that they pay tax on the money they pay themselves out of the business, but that is not the case with some entities. You pay tax based on your share of business income. So if your business earns $100,000 in income and you pay yourself nothing, you are still going to pay tax on that $100,000. And this is because your business must report all income and expenses on its own tax return, and whatever is left in profits is what will flow through to your personal income and be taxed to you. So basically, the IRS is not very concerned about your distributions. They are going to tax your business profits on your individual return. And as a pass-through business, not only are you going to pay federal and state income tax, but you are also going to pay that nasty 15.3% self-employment tax, which is avoidable in some of the other entities here, which makes this a good time to talk about owner's distributions from S-corporations. So the good thing about S-corporations is that they are not subject to self-employment tax, but they are subject to some additional compensation rules. First, you can take owner's distributions from an S-corporation, but only after you have paid yourself a reasonable compensation to all of the shareholder employees or officers that actively participate in the business. So the owners of S-Corps have to put themselves on payroll and pay themselves like an employee prior to making distributions to themselves. The way I explain this to my clients is that you typically get a salary for the work you do in the S-Corp, and then you get distributions for the share of ownership you have in that S-Corp. But secondly, and most importantly, when it comes to owners' distributions, there's another area that typically catches my clients by surprise, and that is capital gains taxes. So with S-Corps, the IRS does not consider you and your business one. So when the business sends money to its shareholders, those are two separate entities transacting there. So because of this, distributions you receive from an S-Corp can be taxable if your distributions exceeds what is called your basis. Now, basis basically represents what you contributed to the business plus your share of profits. And the money you pay yourself from the business decreases your basis, and when your distributions exceed that number, it is now taxable. So for example, if you have a basis of $5,000 and pay yourself $11,000 in distributions, you would pay additional taxes on that excess $6,000 that you paid yourself beyond your basis. Now, if you want to learn more to this, make sure you subscribe to our channel. But in short, if you are not a corporation, you do not pay tax on your distributions. You will pay tax on your business profits, which includes a self-employment tax. But when you are taxed as an S corporation, you typically do not pay tax on owner distributions, but can if they exceed your basis in the business. S Corps do not pay self-employment tax, but you will pay some payroll tax on the salary you take from your business, which we'll talk about in just a second here. But then there's C corporations. So with C corporations, you are taxed twice. Distributions you take from the business are taxable. Technically, they are considered dividends in this case. And the business profits in the C Corp are also subject to corporate income tax. Plus, if you take a salary, you will also pay some payroll taxes. So you're kind of taxed in almost every way with C corporations, except self-employment tax. For my clients, I help them pick the best entity to pay themselves from, and most importantly, help them pay the least amount of taxes. Anyway, so far we've only addressed owners' distributions. But let's talk about the other side of this equation, which involves putting yourself on payroll. Specifically, when should an owner put themselves on payroll and take W-2 wages from their business? So in short, if you are not a corporation, then it normally does not make sense to put yourself on payroll. For starters, you are not required to. Which means if you do, you're just signing up for more payroll taxes and added complexity beyond what is necessary. So if you are in a sole proprietorship, partnership, or LLC that is not taxed as a corporation, you can and likely should only pay yourself with owner distributions. Now, some of my clients that do put themselves on payroll in these types of entities think that they have to, which is just not the case. But one common reason I hear for doing this is that some people think that they need to have W-2 income in order to qualify for loans like car loans, real estate loans, or business loans. But remember, all of your business income is considered part of your individual income. And bankers will typically review your business income when considering loaning money over to you. And they may also ask you for your tax returns, financial statements, or bank statements to support your business income. So typically, only shareholders of S corporations or C corporations should take W-2 wages from their business. This is because corporations do not pay any self-employment tax, so the IRS recoups this by adding payroll taxes on the W-2 salary they receive for the work they do in their business. And a common tax saving strategy is to take a payroll salary that is significantly less than your business income, which can save you thousands of dollars in avoided self-employment taxes. However, like I said earlier, there is a lot of red tape on things like this, and the salary you take has to be reasonable. Though this is something that we help our clients determine over at mycpacoach.com. Anyway, when you are a corporation, you can pay yourself wages and still take distributions or dividends from what is left in the business. And if you are interested in forming an S corporation or learning more about payroll, then subscribe to our channel because I have great guides that can teach you on how to do this. Thank you for watching as always, and I will see you in the next episode.